something else that we have in our portfolios that would produce a larger quantity of dividends because Coca-Cola does pay dividends regularly and Johnson& Johnson does pay dividends regularly. We checked that and confirmed it. We verified it. And the rest of the information, I mean, the rest of the stocks that we're talking about also pay just as regularly, if not more frequently, than Johnson& Johnson and Coca-Cola. So we can buy stocks that are on the rise and obtain a larger quantity of distribution. Experts indicate, before we get started talking about today's portfolio, experts indicate that a good portfolio is anywhere between 7 and 10% return. Anything better than that, while you're dancing around in volatility, you are booming. But stable, reasonably secure, offsetting losses with gains, 7 to 10%. I'm looking at 15 to 20, sometimes 22%. And when we talk about next week about how leveraging your cash stocks for, leveraging your stocks in general for cash loans, where cash loans will be giving you variability towards ownership of assets and still have the security of being able to do whatever you want to do with the rest of your money. I'm going to show you guys next week how utilizing this portfolio that you're building to benefit you towards the acquisition of assets, buying your own house, buying your own car, all this other stuff, where the payments are ultimately going to be less than what they would have been if you would have been running out there trying to rob Peter to pay Paul to try to make it work, trying to fit it into your budget. We're not even going to try to do that. We're trying to increase our stock portfolio so that we can guaranteedly afford to go and grab whatever it is we're trying to grab because of the payout rate of the portfolios that we're dealing with. So stay tuned throughout the show. I want you guys to utilize those reaction buttons to show support towards all the stock options that we're going to be providing you guys so that we can get the algorithm up and going, bring some life to the algorithm so that we can get a lot more people in here to come and grab some information and take it home with them because you guys are going to benefit a lot today. Let's go ahead and get started. The first thing I want to do is I want to ask you guys, what if the classic advice to choose between growth, income, or safety is just wrong? What do you guys think about that? What do you guys think about that? Did you guys know that most investors feel like they have to pick a lane? And now that I think about it, I'm actually going to talk about each lane over the next couple of weeks because this week we're going to be talking about a specific lane about having the best of all. But I believe that in upcoming weeks, we should take the time to talk about a dividend heavy, a growth heavy, and be able to get you guys to understand the difference between all of them. But usually, you either chase high flying tech stocks, cross your fingers on explosive growth stocks, or settle for the slow and steady dividend payers just to get a little more income. And those people who buy and hold the dividend payers, it is a slower growth rate, but it is a stable growth rate because you buy and hold the stock, you're getting your percentage every quarter or you're getting your percentage every month, and it's guaranteed capital. You reinvest the dividends into your principal and grow your stock that way. Safe and slow. Roll the dice on volatility with growth stocks, massive growth, but you get nothing from it unless you sell or leverage it against a cash loan. And for individuals that are coming out of financially challenged households, you don't have to be poor to be financially challenged. You could be making $250,000 a year and be living a $249,000 a year lifestyle. And all it takes is for $5,000 outside of the budget to fuck things up. And now you've got to start pulling out of your stocks and your savings and everything like that to deal with some situations that you was not expecting to deal with. That's what we're talking about with financially challenged households. So when you're dealing with cash dividends, you don't have to worry about that because the money that dropped into the account that can be dropped, direct deposited directly into your account within a couple days, if you're not directly depositing it into your account regardless, you're guaranteed to have an extra income in comparison to the income that you've already got. So you don't have to pull off of your stocks in case of an emergency. You could actually build a portfolio and take the dividends and put it directly into your emergency fund. That way, when you have an emergency, you've got an emergency fund supported by your stock portfolio. There's all kinds of ways that we can do this, but the dividends is what people utilize for the slow and steady and to retire on average on 8%, especially if they're doing a 100% dividend paying platform. They're grabbing a bunch of different stocks that pay dividends. And then the average of the dividend payouts between the highest percentage rates and the lowest percentage rates usually give them between 7 and 10%. Michael says, first thing sold before stocks are watches and jewelry. Special shout out to Michael. He does estate sales, and he can make a good point there. You can sell a Rolex real quick. Sometimes more than what you paid for it if it's in its original condition. But tonight's show, we're going to be showing you guys how to build a portfolio. And this portfolio is designed to give you all three areas at once. And this is piggybacking off of the portfolio that we talked about last week, Tuesday, with Donald Trump's portfolio. His portfolio as a billionaire getting 100 and 200 and $400 shares is easy for him to do. But as a billionaire, that's equivalent to us grabbing $25 stocks. Michael says the AP watches Rolex and Seiko's. See, like I said, and actually a really good watch that is very affordable and actually undervalued is a Hamilton watch. Especially if you grab one of the Hamilton watches that was featured in the Men in Black movie. Yeah, and they actually had three variations of it, but the black one with the silver face was the one most seen by Will Smith. But I do believe one of the managers in that movie, I think it was Men in Black 2, had the Hamilton watch with the gold face, but they still had black bands on them. So think about that real quick when you guys start running out there grabbing yourselves a watch, because the Hamilton watch is like $1,500. Who's spending more money on a watch than they would spend on a car? I don't know, but clearly you can afford it. Now, the portfolio that we're going to be talking about today aims to not only grow your wealth by also paying you a reliable stream of income while growing your stock. And this is going to be all while being more resilient than a simple stock only strategy. So, we're going to get into this real quick because for decades, investing has been pitched as a serious series of trade offs, gains and losses, potential success versus expected failure. And you walk into the financial arena and you're shown three doors. And behind door number one, you have growth. This is a land of brilliant innovation and companies that promise to change the world. It's exciting. Early investors in giants like Amazon, Davita saw truly life altering returns, but this door has a big warning label where these companies are often volatile and reinvesting every dime back into the business, so they pay zero dividends and your entire return depends on the stock price going up, and it can go down just as fast. And for every home run, there are hundreds of strikeouts. And I'm going to give you those stocks as I tell you what Michael was just talking about just now. Michael says not uncommon to make 100% and more. That's his side hustle. Yeah, he does estate sales on a regular basis. But remember, Amazon and Nvidia stock, even though Amazon and Nvidia stock are not going to be the stocks that we're going to be talking about today, those are stocks that I did tell you about last week that Trump is trading on. So if you care, go grab some. Now, this is going to be a path that offers immense potential wealth, but zero income and not a lot of peace of mind. This is something that new investors, amateur investors, novice investors are going to have to take heavy consideration in. Behind door number two is income. And this is the world of the steady and reliable. When you're thinking utility companies, consumer brands, and real estate investment trusts or REITs, they're going to be the workhorses in these particular type of portfolios. And they might not be glamorous, but they generate consistent cash and share it with you as dividends. This is perfect for anyone who wants their portfolio to generate a regular paycheck. The problem? The trade off is often painfully slow growth. A stock with a 5% dividend might only see its price grow by 2 to 3% a year, barely keeping up with inflation. I'm dealing with stocks that are between 15 and 18 to 19% because Orchid Island right now is at 19.35. We have 15% on AGNC, and the last time I checked, about 14 or 15% on Arbor Realty. So averaging those three, you're looking at about 17% between the three stocks. So dividends are pretty high with us, as opposed to other individuals who have higher growth stocks that are paying closer to 5% or 4% interest. While the growth stock, yeah, it does pretty good, the amount of money you're getting per dollar is significantly less. You're going to be collecting quarters on the railroad track while the growth train barely passes you by. That's not what we want for you guys. We want you guys to have higher returns. Now, this is going to lead us to door number three, which is safety. And this is where investors run when they get scared, just like they were scared earlier this year. It's the world of government bonds and high yield savings accounts. And when the market is chaotic, safety feels great. But while your money is protected and you get a small predetermined return, let's be honest, safety isn't an investment strategy. It's a preservation strategy. Inflation as a constant factor, your real return is often zero or even negative, as we discussed in other shows, comparing the 4% increase in inflation and the 3% increase in taxation. You're looking at a 7% loss on your gains. So if you're not turning over 15 to 20% in returns, so that when that 7% is taken out of your profits, where you still have 7 to 8% left over to play with, you're not running the way experts run. You're not growing well. You're just trying to keep it from shrinking. And it's a guaranteed way to never lose much, but also a guaranteed way to never win. So this is a dilemma that traps millions and millions of investors. So you'll be forced to pick a label, growth, income, or first. But these are false choices. They force you to accept less than ideal outcomes. And you're told to sacrifice income for growth or give up on real growth for a small, steady check. For a long term, the narrative was the growth stocks were the only path to real wealth. But in this market, like we've seen in 2025, high quality dividend strategies have actually outperformed the broader index, providing proof that income and stability have immense value. Um, Michael said, I would stay away for government bonds. Look now, Michael's 70 years old. He know what he's talking about. I look, if I can't say if government, F government bonds, but that's kind of where I want to be at right now. Because truth be told, you're looking at government bonds that can be tax deferred. They can be tax exempt over 20 years, especially if they're going in and out of IRAs. And you're still looking at only 4%. 4%. Not a lot to do for your money to sit somewhere for 20 years so that you can avoid the taxation and only get a 4% annual increase on your money. Where sometimes the increase in the bonds, the interest on the bonds, is not that much higher than inflation. It does compete against inflation, but not that much. Typically, about 1.9% more than the impact of inflation. But you think about this: you've got your quarterlies, you got your annualies. They do like monthlies and semi-annuals and stuff like that. But you got your quarterlies, you got your annualities. Then you got your 2 year, your 3 year, your 5 year, your 10 year, your 20 year, and anything under 5 years is all doing 4%. So you can play the slow game and get 4% off your money guaranteed. It's not going to go anywhere because you're buying into the U.S. debt. That what $30 trillion worth of deficit. It is way less than 300 trillion, but it's like $30 trillion worth of debt that we have. You're buying into that, so it's guaranteed that you're going to get your money back. I, I take more risks because I mean I, I drive while black in America, and they treat that like a crime. So I take risks. I don't want 4%. I want 20%. I want 25% if I could find it. You can't really find 25%. Not legitimate. Highest stock option I found right now is 19% as a dividend payout. I can go back and look, but usually REITs are the highest paying stocks in the market. REITs are the most volatile though, but real estate investment trusts are the highest paying stocks in the market. So I I typically just stick to that. But what if we could just knock down the walls between these doors? What if we could build a portfolio that takes the best elements from each one? Yeah, he says REITs are gold. REITs are gold. REITs are definitely gold. Now, a portfolio that gives you the upside of growth, the cash flow of income, and a smarter kind of safety. That's exactly where what we're about to build today. Michael's going to tell you REITs are gold, but they are also good. That's like the golden goose of real estate. That's a real estate investment trust are the golden goose of putting your money into stock portfolios. Um, and one of the things that we're going to be talking about towards the end of the show today is the importance of what type of portfolio that you want. Because I'm going to be giving you guys a series of stocks that y'all can grab. Y'all can add those stocks to the real estate to the dividend rotation stocks that I gave you, the ones that are scrolling across the top of the screen. Because all of the stocks that are scrolling across the top of the screen are dividend paying stocks. A lot of them are quarterly stocks, but they're all dividend paying stocks. If you add the dividend rotation strategy that we're doing right now to your buy and hold portfolio that I'm about to tell you about, you can put more than 60% of your stock portfolio into a buy and hold position using the method that I'm giving you today, and then take the other 40% and utilize the dividend rotation strategy to double or triple your returns off of the 40% that you're rotating out. The guaranteed position of your portfolio from the 60% that's being bought and held gives you stable growth and stable dividend returns. And then you can still play with the volatility of the dividend rotation strategy where you have high risk tolerance to offset any losses that may occur, recognizing that some losses offset the gains of the dividends where you break even. Very rarely do you take a loss if you're doing it right. You're following our lead on the show, but you're not actually taking the kind of risk that you take with Bitcoin, where you put up 50 grand and walk away with a dollar. That's what we're going at right now. We're talking about really making you guys financially successful. So the solution isn't a secret algorithm. It's a powerful and surprisingly simple way of structuring a portfolio. It involves a blend, seemingly opposite types of assets to create something far better. I call it the trifecta portfolio because it's built to tackle all three goals: high growth potential, substantial monthly income, and enhanced safety. Now, the strategy is powered by two engines working together. The first engine is income. Got to have income. And this is going to be the foundation. Its main job is, you guessed it, to generate a steady, high yield stream of cash monthly every single month. This is your portfolio's paycheck. To build it, we're going to be turning to those real estate investment trusts that I've been telling you guys about. So we will be very selective, focusing on the ones that offer both diversification and big dividend yields. Now, this engine is our bedrock, providing stability and the cash that fuels the whole strategy. The second engine is going to be the growth engine. This is where we chase that life changing upside. Its job is to grow in value over the long haul, seriously increasing our total net worth. And this engine is powered by the most innovative sectors of the economy, with technology and with all of the executive orders that's benefiting technology. We're going to be investing in everything from market giants to cutting edge companies in fields like cloud computing and artificial intelligence. And this is the horsepower that drives our wealth forward. Michael says, assets, then comes toys. That's the truth. When you start gaining your wealth, as we're going to be talking about next week, when you have large quantities of assets that you can leverage, you can get cash to buy stuff, whether you're buying land, whether you're buying estate sales, whether you're buying new cars and houses that you can live in and use, whatever it is, the money that you're getting off of this particular investment opportunity aids in your ability to be financially successful over an extended period of time. And this is the biggest goal. This is one of the things that we talk about regularly. So the first thing you got to do is get the money to rotate out for you. And that's something that we have not uh, uh, emphasized enough, because with the dividend rotation strategy, you put a stack of cash up there, you move it around, you double it, you triple it, you keep moving it around, you double it, you triple it. But the thing about it is that with the dividend rotation strategy, you're less likely to be able to buy and sell stocks and leverage those same stocks towards a cash loan. You have to leverage money that is sitting still, so that you can say, hey, if I default on the loan, you can take everything that's not moving. That's what you got to do. That's what you got to do. And that requires buy and holds, which means that your growth stocks would be fantastic to leverage for a cash loan. And then your dividend rotation strategy that you're utilizing with your cash paying stocks have nothing to do with the cash loan. You can buy and sell those as much as you want and utilize that to pay for the loan. And Michael said, only people that say money does make you happy are broke. Doesn't make you happy, or or poor people. Okay, so what he's saying is that those people who say that money doesn't make you happy are people that are broke, people that are poor. And ironically, it is in fact the truth. Uh, Inherently speaking, you cannot buy true love. You cannot buy self-respect. You cannot buy, true friendships. But to entertain yourself, oh yeah, you could be happier than Floyd Mayweather in the strip clubs in Miami. You could be happier than Chris Brown before he punched a girl in the face. You could be as happy as you want to be because you can buy whatever you want, doing whatever you want to do, wherever you want to do it at. With big money comes big responsibilities, and with big responsibilities come big problems. Big problems come with big stressors, but with big money comes big stress relievers. So yeah, you can buy things that ultimately run you content, ultimately run you satisfactory. Money can put a smile on your face. It's not going to be long lasting because the dopamine injection that you get from buying something that you really want only satisfies you until you have it, and then you've used it a few times, and then you're bored with it, and then you're going to go buy something else. But if you've got a bunch of stuff that you bought and only used 5 times, you can sell that shit and go make you some money off of it and go buy something else. It is what it is. Now, most people will stop right there. And if you're still riding a wave with us, you are one of the ones that really want to make something happen. Those people that don't keep going, they might own some REITs and some tech stock, but they see them as totally separate things. Where the real magic of the trifecta portfolio is how these two engines work together to create the third element, which is the safety secret sauce. Michael says, then I buy it and resell your toys. Or if you're one of those Second Amendment fans that likes to buy a lot of toys and hold them for the end of the world, since that's coming soon, you'll have a whole arsenal in your second basement next to your panic room that's identified as a fruit cellar. And you could put a whole like 30-year arsenal down there. Get ready for the next zombie apocalypse. Back to it though. The safety that we're talking about with the secret sauce, this doesn't come from boring zero growth bonds. It comes from the relationship between our income and growth engines. So think about it. The steady river of cash from our high yield REITs does more than just pay us. It gives us capital to deploy strategically. When the market gets shaky and our favorite growth stocks go on sale, we don't have to panic. We have a consistent flow of dividends that we can use to buy more shares of those incredible companies at a discount. We're essentially using the income from one part of the portfolio to take advantage of the weakness in the other. This creates a virtuous cycle where REITs income buys more growth stocks. Those growth stocks appreciate over time and increases the total value of our portfolio. And this structure also provides us a buffer where real estate and tech often move in different cycles. A bad year for tech might be a stable year for our REITs, and the income they provide helps cushion the portfolio's value. Now, the result is a portfolio that's far more resilient in bull markets where the growth engine fires on all cylinders, which is exactly what we're doing right now. However, in bear markets, the income engine provides us a steady stream of cash and a psychological cushion, letting you not only survive the storm, but actually profit from it. So we're building an all-weather machine, one that grows, pays you, and protects you all at once. So let's start with the foundation, the income engine. So our goal here is to generate a big, reliable stream of cash. For that, we're using real estate investment trusts or REITs. A REIT is just a company that owns and operates income producing real estate, apartments, apartment buildings, warehouses, data centers, you name it. That's what they deal with. Cool part is REITs are legally required to pay out at least 90% of their taxable income to shareholders as dividends. And this allows them to avoid corporate income tax. And we, the investors, get the direct cut of the rent checks they collect. So for our portfolio, we're leaning into a specific type of mortgage REIT or MREITs. Unlike other REITs that owns buildings, M-REITs owns the debt on the building. They essentially act like a bank, profiting from the spread between borrowing and lending rates, which wasn't doing that good in April, May, and June when we were able to pick those stocks up at almost $6 a share. Now them bad boys are starting to climb. This model can be more sensitive to interest rate changes, which is the key risk, but it's also what allows them to generate the exceptionally high dividend yields that we need. So here are the specific assets that we'll use to power the engine. For broad exposure, we'll use iShare Mortgage Real Estate ETF, REM. And I'm going to give you this one so that y'all know what we're dealing with. And hold on. Michael says government buildings are REITs. Well, yeah, yeah, government buildings are REITs because the government bought all of those buildings. They're renting them out to whoever's using them, and they're getting a large quantity of payout off of the possession of those properties. So, yeah, you would expect them to do a significant quantity of good. But here is your first stock. I'm giving it to you guys over on Twitch as well. Twitter, you guys are seeing it right now. So I'm passing this information around. But YouTube, you will see this information on a regular basis. You will see this information when you go and watch a show on replay. Now, this is our one-stop shop for the MREIT sector. It holds a basket of the largest mortgage REITs, which instantly diversifies us and reduces the risk of any one company blowing up. Right now, REM is paying a dividend yield of around 9.2%, and that is a true income powerhouse that pays out quarterly. I got you three that'll pay out monthly. We're going to go into those in just a second because those are up top. You're going to see those at the top of the screen. Michael says, actually, the government doesn't own any property but rents it. Uh, okay, so the way it works is that you can subjugate the building from the land. You lease the land. Someone else owns the land. They're still renting someone else owns the house and they're renting the house or renting the land off of you kind of situation. The government building isn't it's considered a government building and the people that are in it rent spaces out of it. But the government building is in fact owned by the government. But since the government is in a fictitious entity because the government is like 501 Congress members, a vice president, and a president, like technically no one person owns it, but it belongs to the government. So can you go and look up the deed to the Senate or the House and see the original owner of the Senate or the House or who the original owner of the White House is? Probably not, because it's not specific to a person. It might be specific to a title, like the president has the White House, but whoever the president is at the time has the White House. You know what I mean? But yeah, you're right. It is somewhat like REITs. On top of that, we're going to add a few individual REITs to boost our income even more. Now, our first pick is going to be Arbor Realty Trust. I'm going to give you that one. That's one that I'm going to be talking about tomorrow, and that one is part of our dividend rotation strategy. So you want to grab this one because we're going to be talking about this one again tomorrow. This one is really good, which is why we're using it more than once. And like I said at the beginning of tonight's show, you can, in fact, take the stocks that I'm giving you today and add them to the dividend rotation strategy where you're buying and holding these stocks and then rotating out a separate set of cash for the other stocks. You can take the dividends from the dividend rotation strategy and add it to the principal of this particular portfolio, expediting the growth of this portfolio. Now, Arbor Realty is a specialized MREIT focused on loans for apartment buildings. So what makes Arbor special is its strong business model, which has not been nearly as volatile as Orchid Island. Their model has allowed it to consistently grow its dividends over the years, and a rare accomplishment to see in this particular type of space. So as of mid 2025, Arbor Realty is paying a staggering dividend yield of over 10%, um, which is pretty decent. But you know me, I told you I fucks with 19%. So next we have two REITs that offer something amazing for our cash flow strategy. This is going to be our monthly dividends, getting paid every month makes it easier to manage your money and compound your wealth faster. First is AGNC Investment Core, which I just talked to you about at the beginning of the show today. That is doing its ex dividend towards the end of this week. AGNC is one of the largest MREITs and primarily invests in agency mortgage backed securities, which are generated by government sponsored entities like Fannie Mae or Freddie Mac, which are loans. Michael said, as of today, Arbor Realty is hitting 11.78%. Look now, you see, you see how we hitting stocks that are like, ooh, they growing, they growing, they growing. It makes you so excited. They growing. I'm wondering where Steve is at because Steve should have been jumped up in here like, where's the money? But AGNC is one of the ones that's doing an ex dividend coming up on either the 28th or the 30th of this month. 28th, 29th, 30th of this month is usually the last day of the month, but we have 31 days in the month. So somewhere around the 30th is when they run their ex dividend, and today's the 28th. So over the next 48 hours, that stock is going to be dropping the next dividend. And if you haven't bought it by the end of the day, if you don't buy it tomorrow, that's kind of it for that particular stock. You're going to have to go and grab some of the other stocks in order to see the increase that you want to have for the upcoming month. And you guys need to like and subscribe as y'all come through because we're going to be giving you a whole lot more stocks as we fly through. Now, this government guarantee reduces the risk of borrowers defaulting. So as of July 2025, AGNC has a massive yield in the 13 to 14% range, and it's going to be paying out monthly. And actually, right now, it probably is actually a little bit higher than that. It might be closer to 15%. Michael says he walking out early tonight. Make sure that you guys like and subscribe as y'all come through here. Now, the next one, our second monthly payer, is Orchid Island Capital. And this is this is the best one to grab. Effectively today, I just seen it right before the show, 19.86% interest payouts. Orchid Island invests in residential mortgage backed securities, and it is generally a bit more aggressive, which can mean more volatility, but also an even higher yield. Now, under normal circumstances, it is sporting a huge dividend yield between 16 and 18%. But right now, today, it is almost at 20%. So if you're buying into Orchid Island, you're getting a ton of capital. Earlier this year, when it was almost $6.80 a share, it was running 22% return. Now, this yield is high when it comes to more risk, but it is exactly why we don't go all in on that. We hold it as a smaller tactical position to accelerate the portfolio's overall cash flow. Now, some people who want to be risque, you can put 80% in the Orchid when it comes down to your REITs, and then put 10% into our AGNC, and then put the other 10% into Arbor Realty, or you can do 70% into Orchid Island and 20% into AGNC and 10% into Arbor Realty, and get your monthly payouts in significant quantities where you would be averaging upward of uh, an average of 16 or 17% dividend returns on money that is sitting still, which is better than what most people are acquiring from other stocks. And this is still going to buffer everything that we're holding. Finally, to add a different flavor, we're including host hotels and resorts. Now, this one is new. I didn't see this one before. And HST is an equity REIT. So you know that after today's show, we're going to be diving into this one and trying to figure out where this particular REIT sits in our monthlies. But unlike others, uh, this one is going to give us our own physical properties. Well, not give us properties, but give us cash off of it owning its own physical properties, where in this case, luxury and high end hotels in prime locations. And this diversifies us away from the purely financial nature of MREITs. So while its dividend yields is more modest, HST offers the potential for growth as the value of its properties increases and travel remains strong. So it acts as a stabilizer, balancing out the interest rates sensitivity of our MREITs. So before we go any further, we want to recap the income engine we have, which is a core holding in REM, a dividend growing machine, in ABR, two monthly payers uh, such as AGNC and Orchid Island, and then the high quality equity from HST. Together, they are going to create the formidable cash generating machine. With our income engine pumping out cash, it's time to build the growth engine. The goal here is simple: capital appreciation. We want to own a piece of the future. So we're targeting companies and sectors with the potential for exponential growth. Now, this is what will take our net worth to the next level. Our approach is strategic, not speculative. We'll build a stable core and then add targets. High conviction bets is going to be the thing that we're putting on top. The foundation of our growth engine is the Schwab US Large Cap ETF. I'm going to give you guys this one. This one is going to give you guys a lot of what you're looking for. And I'm putting these in the comment section so you guys will be able to see these when you go back and rewatch the show. This is our anchor. Okay. Schwab tracks the Dow Jones US Large Cap Total Stock Market Index, which holds the 750 largest US companies. Think Apple, Microsoft, and Amazon. You get a slice of all the powerhouse players. We're not betting on one company, we're betting on the long term success of all of American businesses. Its expense ratio is a tiny 0.03%, so fees won't eat up our returns. Its main job here is to provide steady, reliable, long term growth. With that core in place, we add our first thematic layer, cloud computing. Now, the cloud is the backbone of the modern economy. The globe could, the global cloud market is already worth over $900 billion, and it's projected to grow somewhere between 17% and 21% annually for the next 10 years. So to capture this, we use the global X Cloud Computing ETF. I'm going to give you this one. Y'all are going to look, write these stocks down as they go in, or come back and watch the show again later and write the stocks down later when you've got a pen and paper. This ETF invests in companies set to benefit from cloud adaptation, giving us concentrated exposure to this high growth industry. Now, next, we drill down into the most exciting tech shift of our lives, artificial intelligence. The AI market is projected to grow by 30 to 35% in 2025 alone. And we've still got like 5 months left. To get direct exposure, we're adding BigBear.ai, which Eric just told us about a couple of weeks ago when he was on the show. And lo and behold, Big Bear is doing a good job. So special shout out to Eric for bringing us stock information that we can benefit from. Y'all got to understand, and I'm putting this stuff in the comments for y'all so that y'all can get it and use it. Okay. It's not a household name, but it's a pure play on AI. The company provides AI powered decision intelligence solutions to defense, intelligence, and commercial clients, where this is a higher risk, higher reward play. As a smaller company, its future isn't guaranteed, but its focus on AI analytics gives it tremendous upside potential. Beyond software, we want to tap into other innovative themes. First, electric vehicles. With a position in NOI Inc., NOI Inc. is a leading Chinese EV manufacturer. So we just went from American only to global investment portfolio, which is better for you. China, we're going to start talking about this company in China because the Chinese EV manufacturer is going to be giving us important geographical diversification, where China is the largest EV market in the world. And NIO is a major player known for its innovative battery swapping tech. That's going to be beneficial. It's a volatile stock subject to competition and geopolitical risks, which is why it's a satellite position, not a core holding. So, for exposure to the digital asset space, we're not buying crypto directly. Instead, we're investing in the infrastructure behind it. And that is going to be through Riot Platform. Riot is one of the largest publicly traded Bitcoin mining companies. Y'all didn't know that. So you run out there and go grab you some Riot ETFs, and you would be holding on to a significantly larger quantity of Bitcoin stock at a safer rate. Think of this as a picks and shovels play. Instead of betting on the price of one coin, we're investing in a company that provides the essential hardware for the ecosystem. This is an extremely volatile and speculative holding that should only ever be a small tactical port of a portfolio like this. Now, finally, the round out of our growth engine, we're adding the Invesco QQQ Trust. Let me give you this one. Now, this ETF tracks the NASDAQ 100 index, which is home to 100 of the largest and most innovative non financial companies listed on the NASDAQ. It's heavily weighted towards technology and gives us concentrated exposure to the very leaders that are driving the future, from software to biotech. It's perfectly complementary to our broad SCHX holdings by giving us a supercharged dose of targeted high growth companies. Now, our growth engine is complete. So remember, we have stable core from SCHX, the massive tailwind of CLOU, a high upside bet on AI with BBAI, speculative plays with NIOA or NIO and Riot, all rounded out by the innovation focused power of QQQ. Now we build our income and growth engines using this setup. Now, to make this portfolio truly resilient, we need a supporting cast. The job of these holdings is to add even more diversification, giving us exposure to different parts of the economy that don't fit neatly into high yield real estate or pure play tech. First up, because we've got even more stocks to grab, US Global Jets ETF. Y'all thought we was playing. I told y'all I was throwing stocks at y'all today. Y'all gonna be like, oh shit, I'm gonna have to come back and watch that show. Yes, you will. I don't know what y'all were thinking when y'all thought y'all was gonna skip this one. This ETF is a pure play on the global airline industry. Somebody asked me, was it good to invest in airlines? And I said, it depends on which one. Now you've got an ETF that bets on all the airlines. So the airline business is cyclical. It's going to be tied directly to the health of the economy and consumer travel trends. Holding jets gives us direct exposure to the long term human desire to travel and connect. This asset will behave very differently from our tech stocks and our REITs, providing a valuable diversification benefit. So, to go along with air travel, we're also adding Carnival Corporation. Remember, we talked about this one time before when someone asked me in that same question about airlines, was airlines better to invest in than cruise ships? And I said, it depends on who you are. Now I'm telling you, get them both. the these shows back to back make a lot of sense, and it gives you guys a lot more insight and information than what you would have ever thought possible before. One of the world's largest cruise operators is Carnival Corporation. Like airlines, the cruise industry is a powerful play on consumer spending and the experimental economy, where an investment in CCL is a recovery play with significant upside potential if it can capitalize on the pent up demand for vacations. Next, we'll add another layer of income from the different source with a geopolitical look. Now we're going to be grabbing Global X Super Dividend US ETF. If you haven't noticed, we have a very stacked, very stacked portfolio here. We're giving you guys information all over the place. While our REITs give us high yields from real estate, the Global X Super Dividend is going to be providing us a basket of 50 of the highest paying dividend stocks in the US, including companies in energy, financial, and materials. It also pays a dividend monthly, adding another source of monthly cash and diversifying our income away from being 100% reliant on real estate. Speaking of energy, we're taking a direct position in energy transfer. Give you this stock as well. So if you haven't noticed, I've given you about 4 or 5 dividend paying stocks out of almost 10 stocks already. And this is a fantastic way to keep your portfolio growing. I want you guys to make sure that y'all pay attention to that y'all stay on top of that. Now, Energy Transfer is one of the largest mainstream energy companies in North America, owning a vast network of pipelines. So they are the toll road operators of energy world, with a business that's less sensitive to a price of oil and more dependent on the volume being transported. As of mid 2025, Energy Transfer offers a very attractive dividend yield in the 8 to 8.5% range, giving us a strong income producing foothold in the critical energy infrastructure sector. Finally, we'll add a holding from the media and entertainment space. And nope, we are not investing in Trump media. Paramount Global, that's where we're going. That's a big buy-in. Paramount Global. Make sure y'all like and subscribe as y'all pass through here tonight. We have been giving y'all a lot of stock. Now, Paramount is a media giant with a huge film studio. The CBS network and Paramount Plus streaming service is also there. The stock has been under pressure as it transitions from traditional media to streaming, pushing its valuation to a very low level. An investment in Paramount is a value oriented, constrained bet that is vast for the library of content that will ultimately prove incredibly valuable. So this supporting cast is going to complete the structure. So remember, we have Jets, we have CCL, we have, uh, and that's going to be our travel stock. We have DIV and ET. We have diversified with high yield income using those, and PAR, which is Paramount. We use that to constrain value. These positions make our portfolio more robust and a better equipped uh, format to handle a wider range of economic conditions. So we've now assembled all the pieces. But the most important part isn't the individual stocks, it's how they work together to create a real safety net. This isn't traditional safety, which means hiding in cash and earning nothing. The safety in the trifecta portfolio is dynamic. It's born from the uh, symbiotic relationship between our growth and income assets. So here how it's going to work. Imagine market goes into a downturn. Fear is everywhere. Growth stocks like BBAI or NIO are getting hit hard. The typical investor who is 100% in stocks start to panic. But we are in totally different positions because while growth engines is taking a temporary hit, our income engine is still humming. Our REITs are uh, fueled by the dividends and ETFs that are pumping cash dividends into our account every single month. And this provides an incredible advantage. So, psychologically, seeing that cash arrive is a powerful antidote to fear. It's a reminder that our portfolio is still working for us, which helps us avoid emotional decisions like selling at the bottom. Strategically, this cash flow is our secret weapon where we can take the dividends from our income assets and use them to buy more shares of our growth assets, which are now on sale. We are systemically buying low when our CLOU ETF is down 25%. Our dividend income buys 25% more shares for the same amount of money. This creates a coiling spring. And this coiling spring effect is going to be very beneficial for us going forward. During a downturn, we accumulate more and more shares of our best growth companies at cheaper prices. Then, when the market innovatively recovers, our growth engine doesn't just return to its old highs, it explodes upward. We're now owning more shares, so our rebound is magnified. A market crash, which is something that terrifies most investors, becomes an opportunity for us. The diversification also provides safety. So the forces that drive the hotel market, HST, are different from those that drive Chinese EV markets in NIO. The factor impacting energy pipelines in ET are different from those affecting cloud computing in CLOU. It's unlikely that all parts of our portfolio will be down at the same time, which smooths out our overall returns. This is the beauty of this trifecta portfolio. It's a living ecosystem. The income assets feed the growth assets in downturns. The growth assets supercharge the portfolio's value in upturns. It's a system designed to be anti fragile, one that doesn't just survive volatility, but can become stronger because of it. That is true financial safety. Now, the theory is great, but execution is what matters. So, how do you actually build this portfolio? The good news is it's simpler than ever. Here is the practical steps. Step one, You want to open some kind of brokerage account if you don't already have one. You'll need to open that account with a reputable online broker. I use Stash. You can use whatever one you want to use, Acorn, American TD Ameritrade, or whatever other stock that you want to use, whatever broker you want to use. Look for one with a zero commission trade and no account minimums. Big names like Charles Schwab's, Fidelity, or newer platforms like M1 Finance are all great options. Again, I use Stash. Step two, fund your account. You want to link your account to your bank, deposit the initial investment. The accessibility of this strategy is key. So you do not need tens of thousands of dollars. If your broker offers fractional shares, which lets you buy a piece of a share for for as little as $1, you can build a diversified version of this portfolio with just a few $100 to start with. Um, you really want to lean towards companies that do fractional or marginalized investments, where if you don't have the full amount for the share, you can buy a percentage of it and still get a percentage of the difference from it until you can afford to buy all of it, which works fantastic. Another reason why I use Stash. Step three, buy the portfolio components. Now, for the fun part, you want to log in and start buying the tickers that we've discussed: SCHX, CLOU, ABR, etc. Get them all. Even if you get each one of them at $5 a share, get them all. And then you'll be able to add to them over time. Now, you don't want to just buy one share of each, but if that's all you can get them all so that you know what you're looking for. A simple way to start this is to allocate your money roughly evenly across all 16 holdings. So if you start with $800, then you could aim to put $50 into each one of them. This ensures that you're diversified from day one. Some people might want to be more risky and dump, like I said, 80% of it into Orchid Island and then take the dividends and feed it into the other stocks. Whatever you think is best, but diversification, you have less negative impact in a scenario where you have less of your money sitting on one specific investment opportunity. Now, you want to automate your reinvesting. This is a huge shortcut to building wealth. Utilizing your fintech options, if you go into your account settings and enable the dividend reinvestment plan or the DRIP plan for all of your holdings, when you enable that DRIP plan, any dividends you get is automatically used to buy more shares of that same asset. It's an effortless, automated compounding machine. Step five, monitor and rebalance. A portfolio needs a checkup every now and then, maybe once a quarter or every 6 months. I'm looking at my shit every day. You want to look at your allocations. Has your tech portion grown so much that it's now a huge piece of the pie? Rebalancing is the process of bringing your portfolio back to its target allocations. It forces you to trim some profits from your winners and add that money to your underperformers. So if you have massive growth in your growth stocks, you might want to sell some of your growth stocks and use that profit to buy some of your lower performing stocks, like maybe some of your cash dividend stocks. This is going to be the classic buy low, sell high discipline. Step six is determine the percentage of your portfolio that should pay dividends. This depends largely on your financial goals, needs, common guidelines, and findings from dividend investing experts and communities suggest the following. For income focused investors, especially retirees or those seeking steady incomes, having a significant portion, often between 60% and 100% of their portfolio in dividend paying stocks, is common. For example, some dividend investors on Reddit report portfolios that are 80% to 100% dividend stocks to maximize income. For a balanced approach, many recommend aiming to hold quality dividend stocks that yield around 3 to 4.5%, forming roughly 40 to 60% of portfolios. If you're holding 15 to 20% REITs, you shouldn't be aiming for 4.5% returns. You should be aiming for 15 to 20% returns. Either way, the remaining is going to be in bonds. They actually put that 4.5% into bonds. Michael and I just told y'all don't do bonds, but they'll put it in bonds. And this will be partnered with growth stocks to help balance the risk and the growth. An example given is investing $600,000 in dividend stocks and $400,000 in bonds. That's $1 million for a retirement income plan. Most of us don't have that to do. Portfolio construction, advanced suggestions, diversifying dividend stocks across multiple sectors, and limiting any sector to 25% or less holdings, where you have 20 to 60% dividend stocks to reduce company specific risk. Now, if your priority is growth, the dividend portion may be lower, like 20 to 40% dividend stocks mixed with growth oriented stocks. If income is the priority, the portion should be higher. By following these 6 steps, you can build your own trifecta portfolio. You'll have an all weather machine working for you 24/7, growing wealth and sending your cash to you every single month. So, what started your decision to get into this investing? Because when I looked into this, we started by rejecting the old idea that you have to choose between growth, income, and safety, because you don't. We engineered a solution by combing two powerful engines: an income engine, building with high yield REITs like ABR and AGNC and ORC. So ABR, AGNC, and ORC. Then we put growth stocks powered by broad market funds such as SCHX and CLOU. We then fortified it with smart diversifiers like JETS and ET. And we found, most importantly, the secret sauce, which was a dynamic safety that comes from us using the cash from our income assets to buy our growth assets when they go on sale, turning market fear into a massive opportunity. This isn't just a list of stocks, it's a complete framework for building wealth. It proves that you don't have to sacrifice your future for your present. You can pursue all of it: income, growth, and true safety. So if you found these strategies valuable and you want to see more deep dives on how to build real lasting wealth, you want to hit that subscribe button and the notification button, because tomorrow we are going to be going over the dividend rotation strategy for August, where we're going to be telling you all of the profits that we're going to be gaining off of the investments that we're going to be doing over the next 30 days. Recognizing that AGNC should be bought before the end of business day tomorrow. So is Orchid Island, because those are going to be the ones that we're going to be selling at the end of the week. And we're going to be buying Zim stock before Friday. If you don't have it by the end of business day on Friday, you miss out on the massive quantities of payout of Zim stock for Monday when we sell Zim stock. Building the portfolio that you want is step one. Managing it for long term is where the real magic happens. So you have to know exactly what you're trying to accomplish with your platform or your portfolio. And then you want to figure out exactly what you're going to turn your platform or your portfolio into for your 10 and 20-year plan. Now, uh, I am excited that you guys maintain what you maintain today. Tomorrow, we got a lot of stuff that we're going to be going over. Most of the fellows are going to be diving in tomorrow, and we should be able to bounce back and forward on all of the stock options. So, what I want you guys to do is be sure that you take the time to lock in for tomorrow afternoon show, because everybody who's anybody is going to be here listening to what's up for tomorrow. I know for myself, now that I've provided you guys with all of this information about these stocks, that I am guaranteedly going to be selecting each one of these stocks out of the dividend profits from Orchid Island when it pays out in the next couple of days, because Orchid Island should be paying out between the 30th and the 31st. So within the next 3 days, I will be grabbing at least $5 a share from each one of these stocks, because I use a platform that allows marginalized stock purchases so that I can hold that in my portfolio. One of the things that I didn't talk about yet is one of the, oh no, I did talk about it. I talked about it at the top of the show. If you buy into a higher volatile stock like Orchid Island, where you're putting a larger majority of your funds in Orchid Island, which is going to require you to diversify significantly over time. But if you're putting a larger majority of your money in Orchid Island as you're building up, because Orchid Island is closer to 19% right now, if you took the dividends off of Orchid Island and you bought into other stocks, like taking your profits from Orchid Island and putting it into AGNC, taking your stocks off of AGNC and putting your stocks into Arborility, taking your profits off of Arborility and putting it into your growth stocks, you would then be able to build up on your growth stocks, which would over time level off your portfolio. Where if you invest initially into Orchid Island and then round it off and then start vastly growing your growth stocks, you will find the buy and holds from your growth stocks will offset over time the buy and holds of your cash stocks. You still can have a significant chunk of change that you're following us with the dividend rotation strategy. There's no ifs, ands, or buts about that. Like for example, if you have a $6,000 portfolio and you're using $4,000 in a dividend rotation strategy, and you have the other $2,000 in buy and holds, and you're taking the dividends from Orchid Island and buying into AGNC, taking the dividends from AGNC and buying into ABR, and taking the money from ABR and buying into growth stocks, you can still expand your portfolio that way and still take $3,000 or $4,000 and double it throughout the year, where you would be getting 35. We calculated this, and we're going to be talking about it tomorrow. We calculated this, that all of the stocks that you've seen, and if you're just coming in right now, we've been on for over an hour. You need to go back and rewatch this show and get all the stocks that we were talking about today, because this is a rock solid portfolio where the most expensive stock on here is like $25 a share, and you could get a large quantity of stocks for $1,000, which is some people's income tax refund. You can get a large quantity of these for $1,000 and be able to expand your portfolio and then take the monthly dividends and put it onto expanding your portfolio, where technically you don't have to put anything else into it. You could just let it grow itself. But if you want to expedite growth, you add more of your free time money into that, and then you utilize that to get more money. You take what you get and you put it towards something else, and you keep doing that to increase the value of the overall stock. I love these interesting questions. Special shout out to Bobby. He asked me, "What's your favorite book you have back there?" I love the sarcasm, but let me tell you, the favorite books I've already pulled off the bookshelf. So the one of them is Alice in Cryptoland, which you can select off of the link that we have in the Alice in Crypto Land book. This book is a comic book that gives you all the information you need on how to invest in ETFs and other such stocks and bonds. And the other one, which you can pick up off of Amazon, we have links to that, to the video for that one, is How to Retire on Dividends and Live Off of 8%. That's by Tim Jacobs and Brett Owens, which I got to reach out and see if he's going to come onto the show and talk about how awesome it is for him to live a life stress free. He's a gym coach, or no, not a gym coach. He's a soccer coach, I think, either soccer or baseball for his kids because he doesn't have to work hard because he's living off of uh, uh, interest. He's living off of interest. And that's what we're talking about today is living off of interest. We're talking about building a type of portfolio that produces enough capital for you to live off of. Likewise, which we're going to be talking about coming next week, is the importance of having that growth stock that you can leverage as the ETF stock options that would go towards your uh, cash loans, where you would use cash loans to do things like pay bills, fix your car, buy a new car, buy you a boat, go on a vacation, whatever the fuck you're going to do with the cash. But the stocks leveraged towards that would be held against the balance, and then the rest of it would be giving you money to pay off that cash loan, which makes more sense for you because anything that you put towards the loan isn't going to be taxed, even though we've already talked on the platform plenty of times that any money that's not moving over 121 days isn't taxed up to $64,000 for head of household, $97,000 if you're married. So you could be making almost 100,000 a year off of parking your money in a stock option that's paying you dividends. And if your ideal goal is to have, say, 60,000, let's say $60,000 a payout. I know there's some Americans living in some areas in the United States that clearly need more than $60,000 a year, but let's say $60,000 a year is what you're aiming to get off of your stock option. And if you're getting $60,000 a year and you're utilizing almost 18 or 19% interest to get there, you're looking at every $10,000 that you get is every $100,000 that you get gets you almost 19,000 a year, which means that about $300 to $350,000 into a stock option will get you to $60 to $64,000 a year that you need tax free because you're putting it in there, you're leaving it there, and you're not moving it. Now, how many people has $300,000, $350,000 in the stock market right now? If you don't, you should be following the show every day so that we can talk to you guys about where you can put your money, where you need to take your money from, Martha Stewart this shit, and make your ass some damn money. Because over the last hour and 35 minutes, we have been all of the different stocks that you guys could be investing in a portfolio that will make money for you and grow itself, where you can leverage the value of the total stock towards cash loans that pays for your shit and still make a significant quantity of payout off of your cash stocks where you don't have to pay that debt, which essentially means that whatever the fuck you bought with that loan is free because you personally don't got to do nothing to pay off that debt. This is way different than your paycheck and put it towards some bullshit, and now you got to go back to work for somebody else kissing their ass you to make the money back that you spent on whatever the hell that you wanted. This is leveraging what you're holding towards capital to buy what you want, and then what you're holding pays for what you want. Which means I can sit in this chair and buy whatever I want and not have to get up and replace the money that I just spent. Because the money that I just spent is being paid for by the money that I hold. Now, I don't know what y'all don't understand about that. But if y'all aren't trying to get to this type of lifestyle, because that's how Elon Musk and Donald Trump live the life that they live. They have spent the largest majority of their adulthood moving money around in ways where money is making money for them. When they spend money, they ideally spend it in a way where they're turning a profit off of what they just bought. because it don't make dollars, it don't make sense. And that's like the only thing that you can get from a rap song from the 90s is that if it doesn't make you money, it doesn't make sense to buy it. Elon Musk selling that Cybertruck for $120,000, but you put it in a program where you can make about 40,000 a year off of the truck moving on its own and picking up clients and all this other shit. Yeah, it's an expensive investment, but if that truck is being used as an Uber, 30,000 a year, that truck pays for itself in 4 years. It's a waste of money if you're using it for personal entertainment, but if you're using it as an investment, it's 100% tax deductible of the first year and roll over every year after that for 5 years on what you haven't used, and you can still turn $30,000 a year worth of profit on the truck. Which ultimately, if you're turning over 30,000 a year off of the truck on profit, you can put that towards paying for the truck. So you're not paying for the truck. That's when your stuff makes money for you. That's when you go from having so many liabilities in your life to actually having assets. Assets are things that you benefit from. Liabilities are things that cost you. So let me take you down a heartless position. Your children are liabilities until they are old enough to make enough money to take care of you. Your parents are liabilities when they're no longer paying their way in your life. Your partner in your relationship is a liability when they are not investing in your success financially. Your friends are liabilities when they are not investing in your life financially. Because if you're financially investing in them, they're a liability. When they are financially investing in you, they are an asset. So in order for you to bring balance in these relationships, you have to invest in them as much as they're investing in you. They have to benefit from your existence the way you benefit from their existence in a symbiotic fashion in order for you to be assets to your network the way your network should be an asset to you. Now, Bobby, if you're more importantly focused on the books on the shelf behind me, then you're clearly not focusing on getting your financial life together. And that's the reason why you're trolling this podcast at 1 o'clock in the morning, Monday night, Tuesday morning. The only person on the channel tonight not paying attention to how to make money. I don't know what you think, Bobby, but what I can tell you to do is to swing by tomorrow, try it again, and see if you are willing to make money with us with our dividend rotation strategy that we're going to be talking about tomorrow. Now, with that being said, I want to thank you guys for coming to tonight's show. Ladies, as long as the situation doesn't make sense, I'm going to keep asking y'all to make it make sense. So, ladies, please make it make sense. Fellas, we're about 64% male following. There are more women coming to the show trying to learn how to make money for themselves, since people like Bobby don't have it in their mind to make money for yourself instead of working for somebody else, slaving for the cause. Fellas, I do this for y'all. Help y'all become higher value men financially, help y'all become higher value men with your decision-making skills in your personal lives. But ladies, this information is not gender exclusive. Y'all can take this information and make yourselves higher value women as well. So anybody who has missed what I have had to offer you for the last hour and 38 minutes, you can always go back and replay the show. All of the stock options are in the comment section on live replay after the show. And whatever you don't get from me today, you will get from me tomorrow. I want to thank you guys for coming to the show. Thank you for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I will see you tomorrow night.
to chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. Standing on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. I'm not landing on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.